Good morning, students. We will continue with the lecture of banking and insurance from the topics where we have left till in the last lecture. Now we will continue with the topics where we have left, and we will discuss. We will discuss all the things regarding this insurance in the brief. Now I'm sharing the screen with you, and we will start with the principle. We will give a small recap of the lectures where we have left behind, and we will start with the principles of the insurance. uh, till last lecture we have covered many of the topics regarding this. For example, we have covered the introduction part, your insurance definitions, terminologies, what is the meaning of different words, the terms which have been used in the subject of insurance. And then the definition of insurance. First is the functional definition, then is your contractual definition, and then the nature of insurance. Now we are continuing with the topic, that is the principle of insurance. So the principle of insurance, the topic, first principle, first and the most important principle of insurance is the utmost good faith. Now, utmost good faith means that there must be a good faith of the insurance company in insured and insured in the insurance company. It means that neither the insurance company will hide terms and conditions from the insured, and nor the insured will hide any risk or hazard or problem which he is suffering to the insurance company. Because uh, when we will disclose the facts to the insurance company, then insurance company may reconsider the insurance contract, or it may modify the premium, or it may increase the premium amount, it may decrease the premium amount. But mainly in the case the person hides the fact where there is a chance that the company will increase the insurance premium. Now, to overcome this problem, the people hide some facts, but there is a major flaw in that if in case the insured faces a loss during the period of an insurance, or during the tenure of the policy, then the company may deny settlement of claim if the facts have been hidden. Now, for here we have just in the last lecture, although we have discussed. Now, I will just give you a brief introduction about that. Now, here Mr. John took a health policy, and at the time of taking the policy, he does not disclose to the insurance company that he is suffering from the that he is a smoker. Now, what happened? He got a cancer due to the continuity in due to continuous smoking at the higher intensity. Now that person got the cancer. Now the later on, the insurance company come to know the fact that the person who has been who suffered from the cancer, the insured person who is suffering from the cancer. So the main cause of the cancer, or the main peril of the cancer, is the smoking. So in that case, he has not disclosed, because if he has disclosed this fact earlier to the insurance company, in that case the insurance company may increase the premium, because the risk attached, or the hazard attached to the person's health is more, as he is a smoker than the normal person. So here, this is the one of the major fact, that there must be at most good faith from both of the side, that both as the insurer as well as insured must disclose all the facts and figures to each other. No one should hide any of the fact, or misconduct, or do any misconduct or misrepresentation on anything, so that there is any chances of there is a there, the insurance company may deny in settlement of claim in the future, and later on. Now moving to the next, insurable interest. Now insurable interest means that a person can only take the policy for the subject matter in which he must have an interest. Now, interest means that the person will financially affect due to the loss of particular subject matter. For example, a person has taken insurance policy. A person has taken insurance policy of the stock held by him. Now here, as we know that there is the insurable interest of the owner in the particular goods, because he is the owner of the goods, or he is the owner of the business, and goods are in the possession of the particular person. Now here, if the goods are destroyed by fire or by any of the feral, then the person who is owning the goods has to face the loss. Now in this case, the person can take the policy only if he is having the insurable interest. Now, this principle is most important principle because you cannot take the insurance policy in which you do not have an insurable interest. For example, you cannot take the policy for the business of your competitor because you are not having any insurable interest in that, and there is no direct relation between the business of your competitor and you. Fine. So here the first and most important thing is that the person should have insurable interest, and he must have suffered losses due to the loss of the subject matter or the insured property. Here we have taken an example that we have already discussed yesterday, that for example, a person is having insurable interest is in on life, his parents, his son, his children, and he does not have an interest in your neighbor. If the neighbor dies, then it doesn't going to affect your income or your family income. So your family will not suffer by this. So the person who's having insurable interest. Now next, indemnity. Now this is the another very important insurance principle, that is the third principle, and this is the most important principle again. Here in here the first indemnity means to indemnify the losses. For example, as we have discussed yesterday, a person has taken the insurance policy of rupees 10 lakhs now, of the goods, of the certain goods that are held by him in his business. Now what happened, that due to fire, the goods for rupees 6 lakhs were destroyed. So the person can be only indemnified for the losses which has been actually incurred to the person, or the goods which has been actually destroyed. The person cannot get the compensation for the damages which he has not suffered the loss. For example, now the value of the stock is 10 lakh and insurance policy is also for the 10 lakh, but the goods lost in fire is rupees 5 lakhs. So in this case, after deducting the any salvage value or etc., the company will compensate to the person, to compensate the insured for the goods, the actual loss he has suffered. So here it means that person. So the basic concept of insurance is that that person cannot make a profit from the insurance contract. Now, if to check this clause that you cannot make a profit, the company will evaluate the loss and will compensate to the insured only for the losses he has bear. Now, in this case, it is mainly in the case of your fire insurance and marine insurance, because these are the contract of indemnity. Because here, insurance undertake the responsibility for the compensating the insured against the possible damage or loss that he may or may not suffer. Now, this is for the general insurance. Now, if we are discussing about the life insurance, in case of life insurance contract, the principle of indemnity does not work because a partial value of human life cannot be done. If the policy of rupees 1 crore, if the term insurance of rupees 1 crore has been taken by the insured and the insured dies during the policy tenure, in that case, it doesn't, the company doesn't claim that we will settle the 50 lakh claim because the insured, the loss suffered by you is rupees 50 lakhs. It is not possible. If the person dies, the loss of human being or the life cannot be indemnified. Hence, the in this contract, the contract of life insurance is not included in this principle, whereas this in the principle to indemnity is applicable in all other insurance products. Now, subrogation. Now, another important principle of insurance is subrogation. Subrogation means to stepping in the foot of the person. So, this is again the most important insurance principle. All these seven principles under which whole insurance sector governs are very important and crucial, because absence or violation of any of the principle leads to denial of the company in settlement of claim. So if you want that company should not deny the settlement of claim, all the insurance principle has to be considered while taking the insurance policy by both insurer as well as the insured. Now, what is the meaning of subrogation? Under the principle of subrogation, says that once the compensation has been paid, the right of ownership of property will shift from insured to insurer. For example, the stock worth, you have taken the policy of rupees 10 lakhs, and the stock worth rupees 10 lakh was destroyed by the fire. Now, in this case, if you have taken the claim, if you have applied for the claim and company settles the claim of rupees 10 lakh, then you cannot claim further any amount from any third party as well as from the insurer. And now insurer, now all the rights which you are having as an insured to the third party has been transferred to your insurer, that is your insurance company. Now insurance company can file a lawsuit against the third parties for the recovery of the amount if it has been further discovered that the loss has been incurred due to the negligence of the third parties. Now here, so the insured will not be able to make profit from the damaged property or sell it, because sometimes it may happen that the person after taking the claim sell the remaining value of the property. Now in that case, the person has earned the profit. So as the basic principle of insurance is that the person cannot earn profit with the insurance contract. Now here we are having example. For example, here the house of Mr. John, which has been insured from 1 million, has been destroyed by the fire due to the negligence of has been destroyed due to the negligence of his neighbor Mr. Tom. Now insurance company will settle the claim of rupees 1 million to Mr. John, and now the as the market value of Mr. John's home is 1.2 million. Now the insurance company may file a lawsuit against Mr. Tom, because here the party which due to whose negligence the loss has been occurred, the insurance company has a full right to claim the losses from that party. Now here, if the insurance company files a lawsuit against Mr. Tom and the company wins the case, company wins the lawsuit. In that case, the insurance company will retain rupees 1 million as it has been paid already to the Mr. John, and next the 0.2 million which the company has earned the profit after deducting its legal charges and all the expenses, then and company will pay back to the Mr. John as the market value is rupees 1.2 lakh. So this is the procedure of settlement under the principle of subrogation. Now next is contribution. The principle of contribution applies where the one subject matter has been insured by the two insurers. For example, you have taken an insurance policy from the two company, a fire insurance for the goods from the two insurance company. For example, let's continue with our last example. If we are having, if the goods worth rupees 10 lakhs was insured by two companies, Mr. X, that is X Limited and Y Limited. Let's take a two companies, and the goods are insured by these two companies. Now, in this case, if if the stock is destroyed, then the company can claim for the compensation from any one of the company, either or the both of the company will jointly pay for the losses or the damages, or if one company has paid the full damage, then that company has a right to claim the another 50% from the another company, fine. Or if the claim is taken from the one company, then the person cannot file a claim on the another company. So here the principle of contribution is applicable only when the subject matter is insured from more than one insurance company. Again, the principle of contribution is not applicable to life insurance, because if the person has taken a life insurance policy of the single person from three insurance companies and the person dies, in that case, under the contract of life insurance, the principle of contribution is not applicable, because here again the full amount is to be paid by the both of the companies. Now this principle applies if there are more than one insurers. In such case, the insurance can ask the other insurance to contribute their share of the compensation, or if the insurance claim, if the insured claim full claim from one insurance, the law he loses the right to claim any amount from the another insurance. For example, Mr. Jones insures the property of rupees 1 lakh dollars with the insurers AIG Limited for 90,000 dollars for the MetLife. Now here, if the amount varies of between these two, if the amount varies between these two companies, then the loss will be shared in the ratio according to the premium paid or according to the policy taken. For example, here the losses will be shared in the ratio of 10:9, because for one lakh dollars the property is insured from AIG, and for another $90,000 the property has been insured by the MetLife. So here the principle of contribution is applicable, but in the ratio for which, according to the subject matter has been, for which the subject matter has been already insured. Now next, in this, if the actual loss for the property is rupees 60,000, then Mr. John can claim the full amount of loss of 60,000 either from AIG Limited or from the MetLife Limited, or he can claim $36,000 from AIG Limited and 24,000 from MetLife Limited. This is because here in this case, the company will share the ratio in the ratio of 10:9 because the subject matter has been insured by the two companies. That is uh, that is 90,000 by the MetLife and by the AIG and 60,000 by the MetLife. But whereas the actual value of the property is rupees 1 lakh. So in this case, the either the both of the company will either of the company will pay the full amount of settlement of the claim, or the company will compensate in the ratio of 10 is that is in the ratio of 3 is to 2, that is 90,000 and 60,000, that is 3 is to 2, and that is 36,000 and 24,000 from the both of the company. So here the insurance compensation can be either from the one insurance in the full amount, or it can be from the two insurance companies. It is from the two insurance companies, that is from either from that is in the ratio of the policy taken or the premium paid from the both the companies. So person cannot take that 60,000 loss from both companies, because if he has taken the amount of that is $60,000 from both of the companies, then the amount value of the amount becomes 1 lakh and 20,000. So if the amount becomes 1 lakh 20,000, whereas in this case the total value of insurance is worth rupees 1 lakh only, so he cannot earn more than the value of the asset. He cannot take the claim from two companies. If the same subject matter has been insured from two companies, then the companies will contribute the amount and pay to the person. Or if one company pays in full consideration, then it can recover the proportionate contribution from the another insurance company. So this is written in this rule. Now the next we will discuss is the proximate cause. So proximate cause means, or this is also known as the principle of cause proxima. Cause proxima means what is the actual cause of the loss. For example, a principle states that property is insured only against the incidents that are mentioned in the policy. Now, if the policy is taken for the fire insurance, you cannot file a claim in case there is a loss due to flood or a loss due to theft, because the policy is only for the fire insurance. So in this, the mention if the loss or the claim can only be made for the incident that are mentioned in the policy. In case the loss is due to more than one peril, the only most effective in the causing the damage is the cause to be considered. Now for this, for example, let's take an example that they, the insurance was of fire insurance. Now there was a huge earthquake in the particular area. Now due to that earthquake, uh, there was a short circuit in the house, and before the short circuit, there was a gas leakage in the house due to the earthquake. As there was an earthquake at the high intensity, the gas pipeline in the particular area or the house got damaged, and there is a gas leakage in that area in the particular house. Now, next, what happened that due to electric shock or due to short circuit in the house catches fire and the house was destroyed. Now, in this case, there was three causes. First, the earthquake. Second, there was a gas leakage, and third, there was a short circuit. Now, out of these three causes, the main and the most effective cause for damage is earthquake, because due to earthquake there was a gas leakage and short circuit in the house. So the house has been lost due to fire, but here the proximate cause for the fire is earthquake and not the direct fire. So the effective cause for the damage is to be considered. So if the policy will only cover the fire insurance, then the company may deny or pay partial, because it was been already defined in the policy that the act of God is not covered. So if the earthquake is the act of God, so it is not covered under the insurance contract. So the company may deny in the settlement of claim because due to act of God, due to act of God, the subject matter has been destroyed and not due to the actual fire. If the fire has been occurred due to gas leakage, then the main cause will be gas leakage only. But here there was first of all earthquake, then due to earthquake there was a gas leakage, and due to the earthquake again there was short circuit, and due to that sparking the house got fire. So here the proximate cause for the fire is the earthquake, not the gas leakage. Now, principle of loss minimization. Now, this is another important principle, that it means that person, if the insurance policy has taken by the person, then he must do all the possible effort to minimize the loss. For example, if fire broke out at the particular premises of the business, then the person will not act like that. That as this has been already insured, so the subject matter is insured, and he has not to take any botheration or to control the fire because the subject matter is insured and he can get the claim. So he should not do any negligence, as he thinks that the subject matter of the property is already insured. So he has not to do further any of the acts to save this loss. So according to the laws of according to this loss of loss minimization principle. So here the insured must always try to minimize the loss of his insured property first thing. In case of uncertain events like fire, outbreak, or blast, etc., the insured must take all possible measures and necessary steps to control and reduce the losses in such scenario. So here, the person should do all the possible things to minimize the loss. He should not act as that the subject matter is insured and he has not to take any steps. So the insured must not neglect and behave irresponsibility during the event. So in this case, again, the person should not act or behave in such a way that he has he has to he is behaving irresponsibility towards the parents. So during such event, just because the property of insured, hence it is the responsible of the insured to protect his insured property and avoid further loss. For example, if the fire broke in the one area of the factory, then the owners or the managers or the person responsible must use all the possible effort to control the fire and to avoid the fire to be extend and avoid the extension of fire to the whole factory. So if that is done, that is again considered while the settlement of claim, that how the person has behaved towards the fire, because sometimes it may happen that person, due to the loss, the person itself set their goods or the property on the fire, or damage their property to get the claim. So in this case, in such cases, if there is any loss, then person should try to minimize the loss. For example, Mr. Jones' house is set on fire due to an electric short circuit. In this tragic scenario, Mr. John tries his level best to stop fire by possible means, like first calling nearest fire department, asking neighbor for the emergency fire extinguishers, etc. He must not remain inactive and watch the house burning, hoping why should I worry? I have insured my house. So in this case, as again we have taken another example, a person driving a car should drive the car carefully to avoid the accident. The person should not drive the car in such a way. Now there was some connectivity issues. So again we are online with the topic. Now again I will start the presentation. After sharing the screen, sharing the screen and we will continue with this. Now we are here. We are on the last slide of this particular topic, that is the principles of insurance. So as I have already said that the person should do the maximum possible things to protect the insured subject event. He should not must behave and negligently that the subject matter is insured and he should not do anything. As the person is driving his car on the road, he must do all the possible effort to avoid the accident. He must not drive the car in such a rash way that if the accident occurs, the car is insured and he has not to bear the losses. So to do that, the person should behave properly. Now, continuing with this, we have covered up this topic, that is the principles of insurance. That is the introduction part of the insurance. Introduction, your definitions, the features, the functions, and your principles. So these are the some of the most important things we have to discuss. Now, from this chapter, there are the various questions which may arise. First, what are the various functions of the insurance? First thing, state briefly suitable definition of the insurance. Now, in this case, first the functions, we have to write all the functions of the insurance. Fine. Secondly, brief and suitable definition. Now, here there are two definitions of insurance. One is the functional definition, and second is the contractual definition. So we have to describe both of the definitions. Next, insurance is not to prevent risk but to indemnify the losses arising from the certain risk. Comment. Now here we have to, in this question, we have to write regarding the principles of the insurance, regarding the functions of the insurance, regarding the, we can write anything in this question, because here the question has asked all the wide things that we mostly we can say that we have to explain that the profit cannot be made from the insurance. So in this case, we can only have to we can define the principles of the insurance with examples, its features, that how the profit cannot be made through the insurance contract. And last is what are the various principles of insurance. Again, it is a question which has to be full-fledgedly explained with the example. There are the 7 most important principles of the insurance. So all the principles of the insurance are to be explained with example. So these are the some most important question. Now moving to the next topic, as we have covered up with the covered up with the topic. Now we will share you another slide and we will start a new topic. Let's share the slide and start with the new topic. As till now we have covered the many of the topics from which the question comes in the paper. So let's start. We have covered most of the topics from which the questions come from the paper. Now we will start with the other topic, that is the privatization of the insurance sector, which is again another important topic. So we will start with the new slide, as this is a new topic. So that is privatization of insurance sector. As we know that earlier the insurance sector is totally owned and managed by the government, but now the insurance sector is again it has been controlled by. Now we will start with another important topic, that is privatization of insurance sector. As you all know that before the policy of liberalization, globalization and privatization, all the insurance sector is just like other sectors managed by the government, and it is fully controlled and owned by the government. But there are the various drawbacks due to which the concept of privatization in insurance sector has been done. As there was red tapeism and all other various sectors challenges due to which, and even it is not uh, easy for the government sector to penetrate in the deeper rural areas and all other things. So it is not possible. So that the privatization of insurance sector has been done in India. As we have known that insurance is the most important and most sensitive sector of the country, as all the business are interrelated. So the everyone who is doing the business, every person, a human being tries to take insurance, because he find that in the absence of business or in the absence of the particular life, the legal horrors or the remaining part of the business will not suffer. So within the less than 10 years of independence, the Indian government has nationalized all the insurance companies in 1956 in the Companies Act, which was there in the year 1956. In the year 1956, so the government has a full control and drives much needed for the development funds. So the government in year 1956 nationalized the insurance companies. Next, since the government insurance companies have grown into monoliths, that is, and lumbering and often inefficient but the only alternative. So in this case, there is a monopoly of the government sector. The companies deny in settlement of the claim. Companies, there was a huge corruption in the particular sector. To overcome such things, and again there was inefficiency because some person thinks that they have employed in the government sector and nobody is going to relieve them or nobody is going to fire them. So in that case, and even the persons, the customers is only having available, that is only available available companies, that is the government companies with them. In such case, this have been criticized by the huge bureaucracies, but still the millions of policy holder have no other alternative. So this is the brief history. Introduction. Now the LIC is formed in 1956, whereas, and it has taken over the insurance business in India. That is the life insurance business in India. And General Insurance Company was formulated by the government in the year 1972 to insure the all the other general things. For example, your fire, your marine, your marine insurance, your burglary, your theft insurance, all the types of insurance have been covered by the GIC. That is the General Insurance Corporation, and it was formulated in the year 1972. Now privatization, as the government of Mr. That is the honorable Prime Minister, that is Narsimha Rao. So in 1991 and 96, the government has unleashed various changes and the policy of liberalization, globalization, and privatization has been done. So the term that is used in the, that is, even this rigid, and the India is not having a huge foreign currency for running the country at that in the year 1991, and the government has to pledge his gold in the IMF to buy the dollars to run the country. So there was a critical economic condition in the year 1990-91. So to overcome this, even the government do not want the loss bearing companies in his or her hands, and government wants that more of the private players should enter the market, and the market should be, and the consumer will get the better product. Even if the foreign investment is bought into the country, the foreign reserves of the country will increase, and which will stabilize the ad, adverse economic conditions. So here the government don't, here the term that is used, that government do not want to handle this hot that is political hot potato in the hand, because government knows that if the government will not privatize this sector, then the no foreign player will enter, and if the no foreign player will enter, the foreign reserve will not come to the India. So to overcome that, the company overcome to overcome that problem, the government allows the private sector in the allows the entry of private sector in the insurance sector too. So from after the year 1991, after the implementation of policy of liberalization, globalization, privatization, the various foreign insurance companies or MNCs, multinational companies, have entered the India, and they have started the business in India and start providing the products and services at a competitive price with competitive products to the consumers. Next, all the segments of the financial sector has been opened for the private players with the better product services and social objectives. So here the concept of privatization has started in the year 1991-96. Now here the international players are eyeing the vast potential of Indian market, and they are already making plans to come in. So the private players are already want to enter the Indian market, but due to the huge restrictions, they are unable to enter. So in this case, after the privatization, various companies enter the India, and they have started their business by bringing the huge foreign investment to the India. So the list of private companies that have started, I have prepared a list of private companies that have started the business after the implementation of policy of LPG, that is liberalization, globalization, and privatization. So here are some names of the companies which have entered the Indian market. You can go through this name. This is just a name of the companies which I have bought from IADI website. That the insurance company list of private insurance companies in India today. How many private players have entered after this policy in India? So all these are directly or indirectly MNCs which have entered the Indian market either by the direct entry or by the FDI or by the foreign portfolio investment. So again, there are 24 insurance companies which are India, doing business, which are doing business in the sector of life insurance sector. Although previously we are only having the LIC, that is Life Insurance Corporation of India, but now we are having LIC plus these 24 companies which are working as a private companies in the insurance sector and providing a better and competitive products to the consumer. Even though after this the LIC again start providing the better services to the consumer, as they know that if they will not provide the better services to the consumer will switch to any of these 24 companies which are available. Now next is the list of general insurance company. There are almost 28 general insurance companies in India. Again the AIC, which is agriculture insurance company, now the government has made another insurance company which will look only after the agriculture products. So all these companies are the part of JAC, but AIC again the government has started another new sector for the agriculture, that is Agriculture Insurance Corporation. Now AIC under the JAC will provide license to the any of this private player if they want to run the AIC, that is agriculture insurance business in the country. So these are the list of insurance companies which are working in the field of general insurance company in India till date. Now, why the privatization has been done? What are the main objective of the privatization of the insurance sectors? Here, first to develop the competition in the business of insurance and to make both private and public sector to work efficiently in the insurance business. So this is the first objective. Second, to create more option on the side of customer to purchase the policy. Although, as we know that if there is one or two companies, then there is a monopoly, and monopoly duopoly. In the monopoly or duopoly market is never favorable because they will make the policies which are more for the beneficial of the companies and less for the beneficial of the consumer. So in this case, after the privatization, the option on the consumer side has been increased. Next, to attract more and more people towards the insurance business. Now, as we know that if the more of the company will enter the India, they will provide the job opportunities to the unemployed youth in the country, which will again lead to the economic growth. So it is another objective that the person, more of the person will attract towards this business. Next, to earn foreign exchange from non-resident Indians by getting them involved in assuring them. So again, if the person who is NRI and who is not resident in India, he can again take the insurance policy from the India and from the company which is practicing in India, from any of the company. So this will bring the foreign reserve in India. Next, to raise the capital investment of the people and which can result in improving economic development of the country. Now again, as you all are paying the premium for the insurance, it is not possible that the total premium collected by the company will go in the claims. So the company are left with the huge profits. The insurance sector is left with the huge profit for by which they are forming the capital by investing that idle funds in the stock market or by providing the loans or by investing in some of the other projects. So this will help in the economic development of the country as they are forming the capital. They are forming the capital and which is which will help in improving the economic development of the country. Now next, to create more chances of employment in the insurance business sector. Now again, if the private companies will enter in India, if there are more companies, they will require the more human capital, and as the more human capital is required, the more of the people will get the job opportunities. Next, what are the advantages of privatization of insurance? Now the advantages of privatization of insurance first is private of insurance eliminated the monopolistic business of the Life Insurance Corporation of India. Now here, although we know that as I have discussed in the last, what is the objective, so that is the advantage. So if the, there are more of the companies in the particular business, in that case, the more of the people will get the better product and services. If there is only one company, then the company is in monopoly, and the company which is in monopoly, as I have said, that make the products which are not for the favor of consumer, they will make the product according to their own favor, because by one or another way they are benefiting the company and not the consumer. So now it will over the monopoly, and it helps to introduce new range of product which cover wide range of risk. Now next, this result in better consumer services and help to improve the variety of price of insurance product. Now, if again, if there were n number of companies, they will provide you a product at the less prices or at the competitive price. So in this case, again after the privatization, the consumers start getting a product at cheaper price and with the better that features. Next is the entry of new player has speed up and spread of both life and general insurance. Now, it is not possible for the one company to to snooze their nose in every sector or in everywhere. So when there is more player, they will capture the market. They will capture the market more easily. So and they will reach to the areas where the one company which is not possible for the company to reach. Next, entry of private player will ensure the mobilization of funds that can be utilized for the purpose of infrastructure development. Now again, as there was if there was only one company, then it depends on the company will to how to use the funds. Now if there are more than one company, they will try to maximize their profit and they will try to maximum retention of their consumer. Now what they will do, they will collect the money from the companies and they will mobilize the funds, which helps in which helps in the development of the infrastructure of the country. Next, the participation of commercial banks into insurance business helps the mobilization of funds, because now this is also known as the banca insurance. Now, banca insurance means when we are selling the insurance policy through the banks, or the banks are selling the insurance policy, then it is known as the banca insurance. So, with the privatization, the concept of this banca insurance also come into existence, and by this, the mobilization fund from rural areas, because the banks are have all the government banks are having government as well as private banks are having the branches in the rural area. As by the RBI norm, they have to open some branches in the rural and some in the urban area. So they are having a huge network of branches. So it with the privatization, it has become very easy for the insurance sector to sell their policies through banks or through banca insurance in the rural sector too, and they will start mobilizing the funds from the rural sector too, as the most of the insurance companies has a tie-up with one or another bank. Next, employment opportunity was created in the field of insurance, as we know that if there was a full-fledged sector, then for the for that sector, the persons who are specialized in that are required. So here the vast opportunities are created. Next, the world's best insurance company will came forward and involved in insurance business using the global technology, which we are already seeing, which we are already discussing or having these days. So, so this is how, what are the advantages, and what are the objectives of the privatization of insurance sector in India. The next topic, that is disadvantages, we will start in the next lecture. Now, if you are having on any problem, you can share your problem in comments or by having a WhatsApp message to me. You can drop a message to me. Thank you. Now, next we will start the topic in the another lecture. Thank you.